Once gold is reduced to a liquid state, it loses every stamp, serial number, and identifying characteristic used to track its movement. This physical anonymity makes dealers in precious metals and stones, or DPMS, high-priority targets for international money laundering and terrorist financing operations. Consider the extreme density of gold. A single pallet represents millions of dollars, occupying a fraction of the space required for the equivalent paper currency. Beyond its density, gold possesses universal convertibility. It is an asset that can be instantly liquidated in almost any global jurisdiction, bypassing traditional banking rails. Illicit actors exploit this malleability to move wealth past international customs. By smelting and reshaping pure gold into everyday commercial hardware, like belt buckles, nuts, or bolts, they camouflage the value in plain sight. High value, anonymity, and physical adaptability combine to create a specialized tool for securing untraceable, illicit wealth. To combat these vulnerabilities within the United Arab Emirates, strict operational protocols have been established for the corporate sector. The foundational legislation governing these protocols is Federal Decree Law No. 20 of 2018, which mandates strict anti-money laundering and counter-terrorist financing compliance. This graph illustrates the critical regulatory boundary, a monetary threshold set at 55,000 UAE dirhams for any transaction conducted in cash or cash equivalents. This limit applies cumulatively. Multiple smaller, related transactions are tracked together to prevent the deliberate evasion of reporting limits. Crossing this line immediately activates mandatory compliance and stringent due diligence protocols for the trading firm. This single figure operates as a legal tripwire, separating legitimate commodity trade from federal non-compliance. Managing risk requires active screening for three distinct vectors of red flags during every client interaction. The first vector is behavioral red flags. These are anomalies in how a client interacts with staff or reacts to compliance inquiries. This often manifests as aggressive pressure to rush a deal or a refusal to provide basic identification documents when prompted. Another major behavioral warning is a sudden, unexplained shift into high-value trading that contradicts the client's historical financial profile. The second vector involves transactional red flags. These are anomalies in the physical flow or structural logic of the funds themselves. An immediate transactional warning occurs when a client attempts a massive cash settlement while refusing to document their source of funds. This factor also includes structuring, a deliberate tactic used to stay beneath the 55,000 dirham regulatory threshold. Structuring involves taking a single large sum of illicit cash and artificially breaking it down into smaller deposits that fall just under the reporting radar. Detecting these behavioral and transactional signals shifts a compliance officer's role from passive record-keeping to active threat neutralization. The third vector targets the physical supply chain. This introduces the risk of trade-based money laundering, or TBML, which involves the manipulation of trade transactions to disguise the illicit origin of funds. TBML shifts the compliance focus away from cash deposits and onto the physical movement and valuation of the goods. It regularly occurs within the complex physical realities of international commodity movement across global ports and international borders. Key indicators include conflict gold at steep discounts, discrepancies on shipping invoices, or routing through high-risk jurisdictions. Rigorous detection of these supply chain anomalies prevents a legitimate gold trading firm from becoming an unwitting fence for organized crime. Once a red flag is detected, the workflow transitions immediately into the formal investigation phase. Standard Customer Due Diligence, or CDD, is the mandatory requirement triggered at the 55,000 dirham threshold. This diagram outlines the comparative framework between standard CDD base requirements and the escalated protocols of Enhanced Due Diligence, or EDD. Core CDD involves unmasking corporate layers to identify the ultimate beneficial ownership of an entity. When specific risk triggers are identified, the firm must escalate the file to Enhanced Due Diligence. This escalation targets high-risk profiles, such as politically exposed persons or entities tied to high-risk jurisdictions, which mandate documented verification of the client's source of wealth. This systematic escalation from standard checks to intense scrutiny is the primary operational defense required to insulate the firm from regulatory vulnerabilities. Following the investigation, the final operational step is regulatory reporting. This decision tree maps the specific federal report required based on the detected threat. The Suspicious Activity Report, or SAR, is tied to pre-transaction events. SARs are for unexecuted, aborted, or unusual activities, like a client abandoning a deal when asked for ID. In contrast, the Suspicious Transaction Report, or STR, focuses on the movement of money. STRs are strictly applied to fully executed financial transactions suspected of being linked to illicit proceeds. The Fund Freeze Report, or FFR, is deployed to lock assets when dealing with confirmed sanctioned entities. Finally, the Partial Name Match Report, or PNMR, is used when a subject's name is ambiguously similar to a sanctions list and cannot be cleared internally. Inaccurate reporting compromises the National Financial Intelligence Network and exposes the firm to direct federal prosecution. All documents must be exclusively routed through the UAE's secure GoAML platform. A valid submission requires verified subject details, transaction telemetry, and all evidentiary attachments gathered during due diligence. During this process, compliance officers must avoid tipping off, a federal offense where a client is alerted to an ongoing investigation. This requires the utmost discipline, maintaining perfectly normal business operations face-to-face, while secretly filing a federal report against the client in the background. Absolute operational silence, coupled with the mandatory 5-year retention of records, allows authorities to dismantle financial crime syndicates without alerting the targets. The operational pipeline moves in a deliberate sequence. This chart tracks the journey, from detecting initial red flags, escalating to enhanced due diligence, selecting the correct report, and finalizing the submission via GoAML. Compliance in the precious metals sector is an active defense. It is not a passive administrative checklist. Failure at any stage results in heavy financial fines and the total revocation of trading licenses. Ultimately, these strict protocols protect a high-value, legitimate market from systemic exploitation. Strict adherence to these operational protocols protects the firm from liability while maintaining the integrity of the UAE's precious metals market.